Welcome to Stock Talk with Nico Kritikos. Today we are going to be going through Medifast, ticker MED. And this is a stock I bought about a month ago. I have 6 shares in this account, and then in my other account I have a couple more shares. And so Medifast is a $2.3 billion company that specializes in health and wellness products. They also have coaching services, and their entire business model is based off of helping people grow healthy habits and help them manage their weight, help them sleep better, help them eat better, exercise, all that stuff. So we're going to go look through Nico's stock market checklist and see if the stock checks off all these things. So if it accomplishes at least 12 out of these 16 different things, then that means the stock is considered a buy. So our first 2 on the list are net income and revenue growth. And if we go down here, we can see that over the last couple of years, the revenue and income have both grown nicely. Revenue has gone from 300 million in 2017 to over 900 million in 2020. Earnings have gone from 27 million to over 100 million. So the company is growing very fast. As we can see here, in 2020, revenue increased 31%, earnings increased 32%. So very nice growth numbers there. Therefore, both of these get a check. Next up, is the stock down 35% since this is a mid-cap stock? And if we go look over the past couple months, we can see that in 2020 to 2021, the stock went up and up, and then it hit its high at about $332 a share, and then now it's down to 198. So that is in fact over a 35% decrease, and so that's going to get a check mark there. Next up, how is the return on invested capital and the return on equity? So we come down here, we can see that, this number is a little bit skewed. This is not super accurate, but return on equity was 90%. If we want to get a more accurate number, we can look up return on invested capital for Medifast history, and this will probably give us a more realistic thing because it's not in the thousands of percent. So we scroll down, we can see that return on equity. So return on equity has been growing, and it looks like it is up to 90% now. So those are fantastic returns there. That's definitely going to get a check mark. Next up, are they innovative? This one is kind of interesting. This could go either way. We could say yes, because they are innovating in some ways that they do their coaching models and stuff like that. I mean, I don't think I would call this innovative. I'm going to put no, because they're really just selling simple products and doing coaching. Nothing too innovative there. It's not like they have any innovative tech. So we're going to keep that as a no. How is the management team, and is it founder led? Well, we can see that the CEO of Medifast has, I read a couple articles about this guy. His name is Dan Chard, and he's been CEO of Medifast for about 4 years now. The best thing to judge him off of in the last couple of years is really that the company has grown revenue and income very nicely. So we're going to give him a check, because although he's not the founder of the company, he has done a great job over the past couple of years. And he talked about how he really, when he got into that position, he made sure that he understood where the business was and how the business works and what was the best approach to take. So it sounds like he is a intelligent person and he knows what he's doing. So we'll give him a check there. Next up, healthy profit margins. How is Medifast's profit margins? If we come down here, we can see their gross margin is 74%. Very, very nice. And their final profit margin is 11.8%. That's fine. That's not bad at all. That's good. That'll work. Next up, healthy free cash flow. How is their cash flow? We go to financials and we go to cash flow. We can see here that over the last couple of years, operating cash flow has been increasing nicely from 40 million, 60 million, 80 million, all the way up to now 147 million for the past 12 months. Okay. End cash position has been increasing. The amount they are investing is growing, and the amount they are financing has also been growing pretty steadily too. So cash flows look pretty healthy to me. They have nice profit margins. We're going to give that a yes. Is the industry growing? Yes. I think what they talk about a lot of times is they say that, I want to say they say 2/3 of Americans are obese. And so that's why this market is growing so fast. So yes, I want to say their target audience is growing, and they have plenty of people to target for new customers. And the other thing was they make a lot of money from their coaches. If we look through their investor presentation, so you can actually see here, 70% of the US population is overweight or obese, and it's growing. US adults who want to lose weight, opening to dieting is 75%. So as you can see, those are some great numbers. But if we go down here, we can see that it talks about their coaches, and the other thing with their management team is a lot of their other executives have worked at big established companies like Heinz, like Hershey, like Mondelez, Kellogg's, Johnson & Johnson. So the executives there are smart too. But if we come down here, we can see that it shows you their coaches, and it shows you how much that they're, not only are they growing the number of coaches they have, they're also increasing the revenue per coach. So as you can see here, look how fast it's grown. It's grown 290% in the last 4 years. So that's fantastic there too. And that's really, that got put into place right when the new CEO came into that position. So that's another reason why he's a good CEO. So we'll say that the industry is growing, both in the number of coaches, the amount of customers, and the amount of people willing to jump on a diet. So we're going to give that a yes. A low forward PE. This is one of my favorite metrics. And if we go to statistics here, we can see the forward PE. See, it's not calculated. I believe I calculated this and it was about a 14. Let's see, if we look up what they're expected to do in earnings right now, they're supposed to do, let's say for 2021, 198 divided by 13.9 gives us a PE of 14 right now. Now for next year, on a next year basis, this would give us a forward PE of 11.7 based off of 2022 earnings. So this company is trading extremely, extremely cheap. 11.7 forward PE for a company that is growing revenue and earnings at 63% this year, 16% next year. This company is super cheap. That definitely gets a yes. Next up, more long-term assets than long-term liabilities. We can also find that here on the balance sheet. And if we go to the most recent quarter, we can find current assets at 304 million and current liabilities at 153 million. That's a nice current ratio of about 2. And then long-term liabilities, 15 million, long-term assets, 60 million. Both get a check mark there. Those are fantastic ratios. Next up, do they have a share buyback program, or are they paying out dividends? This company, if we look, let's see. So they bought back, the shares are almost break even. The shares are almost the same. They did buy back a little bit. So not only are they buying back shares, that's not the big thing here. The important one is the dividend. They are paying a 2.5% dividend with a 40% payout ratio, and they grew dividends 19%. Those are phenomenal numbers right there. Phenomenal. Especially for a growing company to pay a 2.5% dividend, that's not very common. That gets a yes. Next up, are hedge funds big investors or insiders buying? Well, insiders, they bought a little bit in February of this year when the stock was around $230 a share. So we're getting it cheaper then. And last time they bought it was $280 a share, $230 a share. So we're getting it cheaper than what all the insiders bought during the last year. Now, the bad part is during 2021 here, you can see the amount of hedge funds holding really went down. It looks like they were buying back here in 2020, and then by the time 2021 came around, they had already sold because the stock price went up. But we're getting it back down to these cheap levels. So that's not a huge concern. So are they buying? No, they are not buying, but that's not a big deal. Increasing equity. Over the past couple of years, we can see, so their equity right now is 194 million. And over the past couple of years, this has gone from 100 million. So it didn't really move much from 2017 to 2019, 100 million, 109, 104, 157. And now it is 194. So it is growing. Over the past 12 to 18 months, it has been growing. So we can give that a yes. That one's kind of iffy, but as long as they keep that up, that should be good. A diverse customer base. Yes, we kind of already went over this. This is, I think they said 90% of their revenue comes from their coaches, and they're making money from the customers buying products as well as the coaches making the money too. So 90% of revenue comes from subscription-based meal plan orders. So subscription, we all know subscription-based income is normally superior to the other types of income, but we're going to give that a check because that is a diverse customer base. So how many yeses do we have here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 yeses. So that's going to give Medifast a 14 out of 16. And yes, that passes as a buy. And that is why I bought the stock. So I think the price target that the hedge funds have is $363, which is an 82% increase. I don't know about that. That might take a couple of years to get to, but I can easily see it hitting 300. That's more attainable. So yeah, I think I'm not a financial advisor, but I do think Medifast it looks very attractive at these levels. It's a fast growing company, good management team. They have a good balance sheet. They're making lots of money and the valuation's low and the stock has come down a lot. So that's why I am a buyer of Medifast.